From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB. I'm Andrew Gagan. Great to have you with us as we round out the week on this Friday at ausbiz. Round out earnings season at the same time. Well, it looks as though we're going to finish quite handsomely here, currently up around 0.4% on the SIBO as we head towards the close. And as I said, all about earnings season, of course. A bit of a mixed session, it has to be said, in regards to what we've had today. But yeah, it's been a long one, but it's been a fruitful one for many. Elsewhere, we've seen retail sales come in flat. Interesting, in fact, we're going to get a catch up with Shane Oliver from AMP in just a moment, and maybe unpack what we're seeing, particularly with the Aussie economy. And tonight we'll get an all-important read on US inflation with the core PCE index. That's the Fed's preferred read on inflation, in fact. All right, let's check those sectors that have been moving today. Energy, the best performer, and that's led by the likes of Woodside and Beach, both up. Industrials also doing well, and much of that is attributed to Downer EDI. Its shares surging in today's trade, up more than 17%, having swung back into the black. Retail, just a little mix. We did also hear from Harvey Norman today. Its shares taking a bit of a hit, down almost 6%. Let's get to some of those top corporate stories. Star Entertainment executives failed to provide the necessary leadership and oversight. That's according to the review commissioned by the New South Wales casino regulator, which was made public today. Shares have been halted. Elsewhere, Ramsay Health Care, those shares have slumped after the private health operator said patient growth would slow this year, as it warned that cost inflation was hurting margin recovery. And Harvey Norman shares have dropped after net profit slumped by 35% to $352.5 million for the past financial year. Now, TPG Telecom is cutting 120 jobs to save some $20 million and to counter sustained inflation after interim net profit slid 40% to $29 million. And data processing outfit Appen tumble after its group operating revenue declined more than 18% to $113 million in a half year due to the termination of a contract by Google. Well, let's get across what we're seeing in the markets at the moment, also at a macro level, both here and overseas. And welcome back to the COB, Shane Oliver from AMP. Shane, good to catch up with you again on a Friday, of course, as we round out earnings season. What's your takeout from what you've seen and heard from the companies this season?
Look, to be honest with you, I think it's okay, but it's not great. We have seen on our count anyway, less companies surprising on the upside than normal, but we've also seen less companies surprising on the downside. We have seen a slight pickup in the number of companies seeing an increase in earnings from a year ago. Likewise for dividends. So you can see in the chart there, a bit less than normal upside surprise, but a bit less than normal downside surprise. So overall, it sort of looks okay, but it's not fantastic. We're not seeing a huge surge in the number of companies exceeding expectations, and we're not seeing a big surge in the number of companies raising their dividends or their profits. So that suggested a degree of caution. I think you can see that in the outlook comments. You can also see that analysts generally have, on average, revised down their expectations. Last financial year came in a little bit weaker than previously expected, slightly bigger fall in profits of around 4.5%, and the expectation for stronger profits this financial year has been wound back a little bit to something like a 4.5% rise. Now, of course, a lot of the swing is due to energy companies. So that's why you are still seeing more companies raise their profits. Obviously, big resources, they drag things down a little bit. But overall, I'd say it's okay, but not great. Market hasn't been too down on it, I think, because investors expect that sometime out there will be an interest rate cut. Obviously, we're seeing that globally, but sooner or later we will see that in Australia as well. And that's why the market, I think, has remained reasonably resilient through August as a whole.
Yeah, so as you sort of referred to there, some companies also dealing with those costs still related to inflation. You mentioned energy companies there. Shane, interesting what we saw, particularly during the week where we got the July read on inflation with the CPI coming in at 3.5%. So moderating there. Some of that obviously due to those energy rebates.
That's right. Yeah, big chunk of it is energy or electricity prices down something like 6%, I think, in the month, down 5% on a year ago. Energy rebates kicking in federally for people in WA and Queensland, yet to kick in the other states. And also we've seen rebates or other things in Queensland at a state level and WA at a state level kick in. But there's still more to go. And so that will act as an ongoing drag. I think the key is that the trim mean did come down. It's still too high at 3.8%. So the trim mean would have stripped out, though, that volatility in energy or electricity prices. So that is probably a better guide to the underlying measure, and it fell from 4.1% to 3.8%, which is not as much as I would have liked to have seen, but it is going in the right direction. And using the monthly data, we are seeing more companies seeing inflation below, more sectors rather, more items in the CPI seeing inflation below 2% than items seeing inflation above 3%. So we're going in the right direction. Not enough in that to tip the RBA over into another hike, but not enough yet to see them start cuts. I think the RBA stance on this and guidance will remain fairly cautious, continuing to indicate that they don't expect to be cutting rates this year.
And Shane, we also got a read on retail trade today for July. That came in flat. What's that telling you perhaps about the state of the Aussie consumer? Bearing in mind also we have had those tax cuts. They came in July. So Aussies perhaps reluctant to spend any of that money?
Well, it seems that way. There was expectations there. We might get a bit of a boost. But I think several things got in the way. We did see some solid increases in the months of May and June on the back of end of financial year sales. So that arguably brought some sales forward into those 2 months. And consumers out there are still very cost conscious, inclined to go for the cheaper option. And so whenever you get sales on, they're out there. When you don't, they're not. But the fact that it was still flat in the month, despite the tax cuts, which were fairly sizable. Maybe people haven't noticed them yet, but I reckon most of them would have if they'd looked at their pay packet or their bank deposits. And their decision to not spend much to keep retail sales where it was suggests to me that they're trying to rebuild their savings after having depleted them. And you can see if you look at the sectoral breakdown, yes, we're spending more on food through time, partly because there's more of us. But if you look at spending on discretionary items like clothing, cafes, restaurants, and the like, household goods, and so on, department stores, they're flatlining. In real terms, they're actually falling. So I think consumers are still strapped for cash, still struggling. Yes, the tax cuts were welcome, but obviously people didn't go on a spending spree. And when you put that together with the soft capex numbers out yesterday, on Thursday, and soft construction numbers out on Wednesday, both for the June quarter, it suggests the Aussie economy still remains pretty soggy, and we're not going to see a lot of growth through the June quarter, and things look like they've stayed soggy going into the current quarter.
Shane, let's turn to what we're seeing in the US, of course, with anticipation of the rate cuts coming at the next Fed meeting next month. Ahead of that, we do get that core PCE read tonight out of the States. Next week, we get the non-farm payrolls. Are they possibly likely to determine how large that cut is from the Fed?
I think they will. Powell last week at Jackson Hole clearly signalled that rate cuts were coming. In September, he said the time has come, or something to that effect. And that, I think, tells us where we're going. The debate is whether it's going to be 50 basis points or 25. The market, I think, still has something like a 75% chance priced in of a 50 basis point cut. But the data so far probably don't support that. The data in the US so far has been relatively benign. GDP revised up for the last quarter, partly on the back of stronger consumer spending. Not that that's a forward indicator of anything, it's a backward-looking indicator. But if you look at jobless claims overnight, they actually edged down a little bit in the initial claims side of things. If you look earlier in the week at durable goods orders, capital goods orders, they look pretty soggy, absent the volatility you see in airline orders. So overall, it looks to me like an economy which is slowing down, but probably not weak enough yet to bring on a 50 basis point cut. But Powell did say he's not going to welcome any further deterioration in the US jobs market. So those jobs numbers out in a week's time are going to be looked at pretty closely. And if we do see a further upleg in unemployment, I don't think we will for August numbers yet, but we will in the months ahead. But if we do see a further upleg in August, that will be of a big concern to the Fed and tip them over to a 50. But I think the more likely scenario is that they go with a 25-point cut.
Yeah, interesting. Jerome Powell bringing the punch bowl back to the table. It's just a question of how punchy it is going to be. Shane, terrific to catch up with you to sum up the week and also what's ahead. Thanks for joining us from AMP.
Thanks, Andrew. Thank you.
All right, let's take a look at our stock of the day, and that is Downer Group.
I think this is the type of move where, you'd be looking to sell in a few days' time. I don't, not too dissimilar to, WiseTech was an example of a stock that, shot the lights out on the day, went up for I think another couple of days, and now it's heading sideways. So, that was a stock that we held and we sold into that strength, in anticipation that it might just do nothing for a while until we get the next catalyst.
I agree that it's got some momentum on this move. It'd probably go up again in the next couple of days, but then I would be certainly taking some profits and waiting for a pullback. I wouldn't be chasing it on this breakout, which is huge today, up 18%. But it certainly looks like it could have the momentum to continue going higher over the next 6-12 months, especially with the orders that they've got in the pipeline, 38 billion. So it looks like that's a turnaround story, and the next peak I can see to test would be around $6.10 somewhere, and if it breaks that, then it's $7.50, which is the where it was pre-COVID high.
That was David Novak from Wealthwise Education and Michael Gable from Fairmont Equities on Downer Group. Let's take a look at the market leaders as we round out the week. Downer EDI, our stock of the day, they're up more than 17%. Karoon also doing well, and bigger off the back of its results, as well as TPG Telecom doing well today. As far as those that have fallen, Ramsay Health Care is down 8%. Harvey Norman taking a bit of a tumble too with its outlook. Let's take a look at what is on overnight. We do get that key PCE read tonight, which is the Fed's preferred measure of inflation. And locally next week, we've got ANZ job ads, national accounts, international goods trade, also a speech by RBA Governor Michelle Bullock. And globally, we get some detail out of China with manufacturing index, also the ISM out of the States, trade balance from the States, also a raft of jobs numbers, including the non-farm payrolls. All right, let's round out where we're finishing the week. We are up around 0.4% at this point. Thanks for joining us. Stay with us. The last call is up next.